50-some days into a shooting war between Israel, the United States, and Iran, with the Strait of Hormuz effectively closed for business and oil pushing past $100 a barrel, the largest bank in the United Arab Emirates opened its books to the public. And what it told shareholders was, profit went down. 2%. First decline in years. If you stopped reading right there, you'd walk away thinking First Abu Dhabi Bank had a bad quarter. It didn't. What it actually did was something more interesting than either a good quarter or a bad one. And figuring out what that was, and what it tells us about how a well-run bank is supposed to behave when the world gets genuinely ugly, is what we're doing today. Welcome to the Veritas Brief, the podcast from Veritas Europaea, where we take the stories everyone else covers in 600 words and give them the 6,000 they actually deserve. This week we're doing something a little different for us. We spend most of our time on European political economy, the ECB, Brussels, Berlin, the currency, and the politics that move it. This week, we're going to the Gulf. And we promise that by the end of this episode, you'll understand exactly why a bank in Abu Dhabi belongs on a show about Europe. Today, First Abu Dhabi Bank's first quarter results. On paper, a small profit decline. Underneath, a story about war, capital discipline, and a balance sheet that is never really operating alone. Let's get into it. Let's start with the number that made headlines, because it's also the number that's most misleading if you take it at face value. On the 23rd of April, First Abu Dhabi Bank, FAB, as everyone in the region calls it, reported group net profit of 5.01 billion dirhams for the first quarter. That's down 2% from the same quarter a year earlier. For context, this is a bank that spent all of 2025 posting one strong quarter after another. So a decline, any decline, was going to get attention. Here's what the headline number doesn't tell you. FAB's chief financial officer, Lars Kramer, told analysts on the earnings call that profit would actually have risen around 3% if the bank hadn't set aside 300 million dirhams in what's called a management overlay. We'll come back to exactly what that term means in a minute because it matters. But strip that one line out, and the underlying business had a genuinely strong quarter. Operating income up 6%, net interest income up 12%, earnings per share beating what analysts expected, and return on tangible equity at 17.8%, comfortably ahead of the bank's own target. So the headline number is real. It's just measuring caution, not weakness. FAB's CEO, Hana Al-Rostamani, framed the results around, her words, the strength of our diversified franchise, disciplined risk management, and strong credit profile, which sounds like boilerplate until you understand exactly what the bank was navigating underneath it. So what was it navigating? This is where the story gets genuinely interesting, and it's also where this episode earns its place on a show about European political economy. On the 28th of February this year, war broke out. Israel and the United States on one side, Iran on the other. It ran through FAB's entire reporting quarter. Iran fired missiles and drones at targets across the Gulf, including Dubai. And the Strait of Hormuz, the single choke point that something like a fifth of the world's seaborne oil passes through, came under direct threat for the first time in a generation. Think about what that does to a regional economy. Tourism slows, aviation slows, hospitality slows, and oil, which drives an enormous amount of the fiscal and monetary math in this part of the world, spiked past $100 a barrel before eventually settling back into the 80s. FAB's own economists were tracking this in real time from the trading floor. Their Q1 oil note had actually projected the Hormuz blockade would lift by early May, and by the time results came out, the bank had revised its full-year outlook. Oil near $83 a barrel, UAE growth cut from 5.6% to 4.2%, and, this is the part that matters for a European audience, a complete reversal of its interest rate call, from expecting cuts to expecting rates to just sit still. Because here's the thing, none of this stayed in the Gulf. Higher oil prices feed straight into global inflation math. JP Morgan's own analysts said in late March that the European Central Bank could respond to this exact shock with 2 additional rate hikes. A war fought over a strait in the Middle East, reaching into financing costs on the other side of the Mediterranean. That's the connective tissue that makes this a Veritas Europaea story, and not just a Gulf banking story. Back home, the UAE's central bank didn't wait around to see how this would resolve. On the 17th of March, it rolled out what regulators called a resilience package. 5 pillars, the most significant intervention since COVID. Banks could draw on up to 30% of their cash reserve requirements. New liquidity facilities. Capital buffers temporarily released. The regulator said total liquidity sitting at the central bank plus eligible assets was close to $250 billion. Standard Chartered's Henrik Raber, speaking at a conference in Miami around this time, put it about as plainly as a banker ever puts anything. We're going to be fine. Medium term, we're positive. And ADCB's chief economist, Monica Malik, read the resilience package the way the market ultimately did. Not as alarm, but as reassurance, describing it as, quote, supporting macro stability and broader economic confidence. But here's the number that tells you the war was real, and not just a headline. The UAE's monetary base fell 8% in a single month as people moved money out or drew down savings. That's a genuine, measurable cost. And it's exactly why FAB's 300 million dirham overlay looks less like an accounting trick and more like a rational response to a quarter that was, by any honest measure, unusual. Now strip away the war narrative for a second, because a bank's balance sheet has to answer a more basic question regardless of what's happening geopolitically. How much of a shock can it actually absorb? FAB's core capital ratio, CET1 for anyone who tracks these things, came in at 12.8%. Comfortably above the regulatory floor, but down about half a percentage point from the previous quarter. 3 things drove that. Retained profit added some back. Loan growth, the bank actually lending more money, subtracted some, which is a good problem to have, not a bad one. And FAB redeemed a bond instrument on schedule, which thinned the ratio a bit further, but was a choice, not a scramble. Quick pause. If you've made it this far, you already know the kind of work this is. Slow, sourced, and unafraid to give the other side a hearing. Here's the thing. Veritas Europaea has no advertisers buying your attention, and no billionaire backer steering the line. There's a certain irony in saying that on an ad break, but this is the ad. It's reader-funded, and it stays that way for a reason. €2 a week. That's it. That's what keeps the lights on, keeps the analysis independent, and keeps it free of the gatekeepers who decide what you're allowed to read. Now back to FAB. More telling, FAB's liquidity coverage ratio was 145%, way above the regulatory minimum, in the exact quarter when liquidity was the variable under the most pressure region-wide. That's not an accident. Now, back to that phrase, management overlay. Here's the plain English version. It's money a bank sets aside against losses its models haven't actually detected yet. It's a bet that things might get worse. It is not a confirmation that they have. And the asset quality numbers back that reading up. FAB's non-performing loan ratio hit an all-time low of 2.1%, down from 3.3% a year earlier. Provision coverage, the cushion held against loans already flagged as bad, rose to 110%. A bank whose bad loan book is shrinking, while its cushion against the bad loans it does have is growing, isn't quietly absorbing a credit problem. It looks much more like a bank that spent 2025 cleaning house and used this quarter to bank the resulting flexibility rather than spend it. Context helps here, so let's put FAB next to its 2 closest rivals, because all 3 reported in the same week. Emirates NBD posted net income up 3%, on revenue up a striking 21%. Faster top-line growth than FAB, though a smaller profit beat once you account for rising impairments, partly tied to its Turkish subsidiary DenizBank. Their CEO, Shane Nelson, credited what he called strategic investments in our regional footprint, digital capabilities, and Gen AI. Abu Dhabi Commercial Bank, the country's second-largest lender, actually had the strongest quarter of the 3 on almost every ratio that matters. A record-low cost-to-income ratio, and a non-performing loan ratio even lower than FAB's own record low. Their CFO, Deepak Kular, pointed to what he called a diversified revenue mix and enhanced efficiency. So who won? Honestly, that's the wrong question. FAB is still the largest by a wide margin and posted the best return on equity of the 3. ADCB is the efficiency leader. Emirates NBD is growing the fastest, but carrying the most cross-border complexity. The more interesting takeaway might be that all 3 UAE banks had a genuinely strong quarter in the middle of a shooting war, which tells you how much capital this sector had banked during 2025 before any of this started. Now here's the part of this story that almost never makes it into a standard earnings write-up. Honestly, it's the part that made us want to cover this on a European political economy show in the first place. FAB's chairman is Sheikh Tahnoun bin Zayed Al Nahyan, and he is not simply a bank chairman. He also chairs the Abu Dhabi Investment Authority, a sovereign wealth fund with something like $790 billion under management. He chairs ADQ, a state holding company. He chairs MGX, a technology investment vehicle. He chairs G42, the UAE's flagship artificial intelligence company. And on top of all of that, he's the UAE's national security advisor and the deputy ruler of Abu Dhabi. This isn't a detail about personality or about politics for its own sake. It's a detail about capital structure. A bank chaired by the same person who allocates a meaningful share of the Emirates' sovereign wealth sits inside a completely different risk perimeter than an equivalent bank anywhere else would. It's a big part of why UAE government liquid assets run to something like 211% of GDP, one of the highest sovereign buffers anywhere on Earth. And it's a big part of why, when the central bank moved in March, almost nobody seriously questioned whether the backstop behind it was credible. For a show that spends most of its time tracing how political power and capital intersect across Europe, this is the same dynamic. It's just playing out in the Gulf instead. FAB's balance sheet and the UAE state are not fully separable. Pricing this as a plain commercial bank misses a large part of where its resilience actually comes from. Let's talk about growth, because FAB's real growth story this past year hasn't been geographic. It's been technological. The bank says its AI deployment now touches more than 95% of its structured data, and it's already running over 1,000 AI agents in production. Forbes ranked it the #1 bank in the UAE this year. It holds the strongest combined ESG ratings of any lender in the region. But here's the more interesting thread, and it's a bit of a cautionary tale. FAB has repeatedly tried, and repeatedly failed, to buy scale outside its home market. In 2024, it was in advanced talks to buy a majority stake in Turkey's Yapı Kredi for around $8 billion. The talks collapsed within weeks, over roughly $500 million of disagreement on price. And that wasn't a one-off. FAB had previously explored a bid worth as much as $35 billion for Standard Chartered, and an approach to Egypt's EFG holding, without completing either one. 3 attempted deals, roughly 3 years, 0 completions. That cuts against the easy assumption that Gulf banks with sovereign-linked capital just throw money at whatever they want. What it actually shows is a bank willing to walk away from a target it could technically afford, again and again, rather than close something it judged overpriced. Whether that's admirable discipline or a missed window to build real international scale, honestly, that's a fair question. It's one FAB's own shareholders are better placed to answer than we are. So what's the market actually doing with all of this? FAB shares fell about 1.5% immediately after the results, more a reflection of the war's shadow over the whole region than anything in the numbers themselves. From there, the stock recovered, into the high teens by mid-May, and roughly 17 to 18 dirhams through June, tracking the same de-escalation that eased oil prices back down. Analysts, for what it's worth, have stayed positive through all of this. Of the roughly 13 who cover the stock, 10 rated a buy, 3 a hold, none a sell, with price targets clustering around 21 to 22 dirhams. At something like 9 to 10 times earnings, below the broader UAE market average, and a dividend yield above 4%, the market is pricing this stock like a mature, cash-generating utility, not a growth story, which, given what this quarter actually was, is probably the correct way to price it. So as we wrap up, 3 things we'd actually watch for from here. 1. Does that overlay come back out, or does it grow? FAB reports second quarter results on the 29th of July. If the war's fallout keeps fading, we'd expect at least part of that $300 million to get released, which would validate this quarter's caution. If it grows instead, that tells you management sees more risk ahead than the market is currently pricing in. 2. Where oil and interest rates actually settle. FAB's own house view assumed $83 oil and rates on hold for the rest of the year. Either one moving meaningfully, a fresh disruption in the Strait, or a Fed and an ECB that diverge from that assumption, ripples through both FAB's margin guidance and the region's broader fiscal position. And 3. Whether the central bank's resilience package gets quietly extended or quietly unwound. It was explicitly framed as temporary, How and when it gets unwound will tell us a lot about whether the authorities actually think this is over. That's First Abu Dhabi Bank's first quarter, a headline decline that was actually a story about discipline, a war that reached further than anyone expected, and a balance sheet that was never really standing alone in the first place. If you want the full written version, every number, every source, 2 charts we didn't have time to describe here, it's up at veritaseuropea.eu, along with everything else we publish. And if this kind of analysis is useful to you, the honest truth is, the only reason we can keep doing it at this depth is because readers become members. It's genuinely how this show stays independent. Thanks for listening. We'll see you in the next one.